Welcome back. Today we're looking at a piece on AMC stock, focusing on that critical $2.20 level and the bull versus bear fight happening right there.
Yeah, it's a great breakdown of the sentiment clashing with the fundamentals. The optimism around the super slate of firms versus the very cold hard numbers on the balance sheet.
Absolutely. It captures that tension well. But let's jump right in. I think we can make the stakes feel a lot higher for the reader.
You mean making that financial tightrope they're on feel real, like it could snap?
Exactly. So, my first point is this. The material needs a time-bound metric to fully stress test the bull thesis against the massive debt load and FCF burn.
Right. It does a great job of saying, here's the $4 billion in debt, and here's the $81 million they burned last quarter. But the good news, the catalysts, they don't have a number attached to them showing how much they actually fix that problem.
Yes, it leaves the reader wondering, okay, but is it enough? And how soon do they need it? There's no sense of urgency.
So the suggestion is to build in a mechanism for the reader to actually see that runway, to visualize the clock ticking.
Precisely. Let's make it concrete. We suggest creating a clear cash clock. I mean, you take the reported $365 million in cash.
And you pit it against that $81 million quarterly burn rate.
And you can model it out. You can say, look, at this rate, the company has about 4.5 quarters before things get truly critical. Suddenly, that late 2025 film slate isn't just important. It's a do-or-die event.
That puts a non-negotiable timeline on the bull case. I love it. Okay, that actually leads really well into the second point, which is about the value trap argument.
Oh, yeah. The disconnect with the analyst targets?
A huge disconnect. So here's the topic sentence. To strengthen the value trap argument, the analysis must directly confront the huge disconnect between analyst price targets and balance sheet liabilities.
The piece mentions the average target is around 335, implying 50% upside. But it kind of just states it. It doesn't slam it up against the negative $1.8 billion in shareholder equity.
Exactly. And that's not just a small detail, that's a gigantic red flag. So the analysis needs to dig in and probe the why behind those high targets.
Right. You have to ask the hard question. Are analysts so focused on, say, forward positive EBITDA that they're willing to just overlook the enormous negative book value?
Or you state the flip side explicitly. You say, look, with a $1.8 billion equity hole, this stock is an imminent dilution candidate, regardless of a short-term pop above 215. You have to connect those dots.
So a concrete example would be to frame it as a direct question in the text. Something like, is this high price target based on a hidden fundamental argument, like maybe the assumption that all the big asset write-downs are done? Or is it purely speculative hope?
Yes, that forces the reader to confront the contradiction themselves. It makes the value trap argument something they discover, not just something they're told.
Fantastic. Okay, so to recap the two big suggestions here.
First, quantify the burn. Create that cash clock so the reader understands the immediate timeline and the exact performance required from the super slate.
And second, use that negative $1.8 billion shareholder equity number as the main tool to deconstruct or at least seriously question the logic behind those high analyst price targets.
These two changes will make the whole piece much sharper and give the reader a much clearer framework for evaluating that 220 battleground.
Agreed. We'd love to see the revised version. Send it back our way when it's ready, and we'll take another look.